Hi, welcome back to the second video in our series, finishing up the conceptual framework. And in this video, we are going to be talking about not the difference between chapter 2 and chapter 5. Instead, we are going to be talking about the way to view capital. Okay, and so basically what we're told in chapter 8 of the conceptual framework is that the way we view capital is very important. So the way we view equity basically is very important. And they say there's two concepts, there's two ways to view it. The first way is what we call financial concept. And this relates to the fact that the net assets, or another way to say that is the equity, is purely from a financial standpoint, purely from a rands and cents standpoint. So that is what we call financial capital, right? And so they say that's one way of viewing it. So one way of viewing it is purely from a rands and cents standpoint. Then when we talk about the other way of viewing capital, we view it from a physical capital standpoint. And so physical capital talks about the ability to produce, the ability to add value. And so we always say we've got two shareholders, right? One very small shareholder. When they invest into the business, all they're looking for is money to be put back into their pocket. So all they're looking for is how much do I invest, how much dividends do I get, or how much do I invest, how much will I get when I sell the share. That's their relationship to the business, right? They're not interested in what the business is producing, etc., etc. They just want to make money from a financial standpoint. When we look at, let's say, someone who owns their own business, like a sole trader, that person won't view capital from just a purely financial standpoint. So, for example, if you put money into your business, you are more concerned about what that money can do for your business, right? So you view capital from what we call a capacity standpoint. So how is this going to improve my business, right? And so productive capacity is another way to view capital into a business. Now, for example, if you put new money into your business, you might assume that now that your business has more productive capacity, they are able to produce, let's say, 500 additional units. So that's what we talking about when we talk about financial capital versus physical capital. Just like a small shareholder in a big company will only view that transaction from a financial, from a how much can I get out of it standpoint, from a monetary standpoint, whereas a sole trader, where the owner owns the entire business, he views his business as a tool to produce goods, a tool to add value into the world. And then when we talk about maintenance, all maintenance is referring to is profit. So capital maintenance is profit. And so let's think about that, right? So for example, we measure profit and we measure it as basically a percentage of our capital invested. So that's why we have what we call ROA, etc. For example, if we have assets and we sell all of our assets, right? We need to take into account what they cost us and the difference between what they cost. Let's say I'm talking about inventory, right? So the difference between what inventory cost us and what we sold it would be considered a financial profit. Okay, that's how we would calculate a financial profit. That is talking to capital maintenance. What is the capital doing for me? Right? How am I measuring the doing of the capital? Whereas you might take another entity, and that entity would say, well, you know what? I'm not interested in how much rands and cents come out of it. Instead, what I want to see is I put 10,000 rand in. How many new units can you produce for me? How much new stuff can you sell for me? So they might view it from a capacity standpoint, from a productive standpoint. And so what the method in which a company views their capital or their equity actually dictates how they will do their accounting. For example, if someone were to buy land, right, and they were only viewing it from a financial capacity standpoint, they would say, let us measure the land at how much we put in, right? What was the cost of the land? So they would use historical cost, right, when they are measuring land. And then when they sell the land, they'll say, well, the selling price minus the cost is what's going to give me my profit, right? But if we view it from a capacity standpoint, from a physical standpoint, we might say, okay, when I bought the land, I was able to do this with the land. I was able to maybe produce the land. And therefore, my ability to produce would change year from year. So I then would measure it, let's say, using a different model, let's say a fair value model or something similar to that, right? So I would maybe measure my land using a different model that's more of a current cost, current value type of model. And so we have in accounting something we call the revaluation model, which is similar to a current value model. So if you were financial capital, you would use historical cost. But if you were using physical capital maintenance, you would actually go towards more of a current value because you want to reflect the capacity that you have. And you want to also show from 1 year to the next, my capacity is changing. Even though I'm not buying a new piece of land, what I can do with the land is changing. And so you might use something like a current value. More, it will be better for you if you prescribe to physical capital to use a current value as opposed to historical cost. Okay, so that is our discussion on capital and capital maintenance. Thank you for watching. Please make sure you come back for the last video in our series.